Right now, there is a very good chance your savings account is paying you around 0.4% interest. And there is an account sitting one click away with the exact same federal insurance and the exact same access to your money, paying more than 10 times that. On $10,000, that is the difference between earning about $40 a year and about $440 a year. Same money, same safety, same ability to pull it out whenever you want. The only thing different is the number on the account, and the fact that one bank is quietly counting on you never checking. Here is what I am not going to do in this video. I am not going to hand you a list of 5 bank names because those rates change constantly, and that list would be wrong in a month. Instead, I'm going to give you the 5-variable framework that lets you evaluate any high-yield savings account in any rate environment for the rest of your life. And near the end, I will show you the one situation where a high-yield savings account is actually the wrong choice, even though almost everyone defaults to it. Quick one before we start, drop a comment with what your current savings account pays you. Just the rate. I genuinely want to see how many people are stuck at that 0.4%. It helps the video too. Like it if you're in, and let's get into it. First, let's be clear about what we are even talking about, because the gap is almost hard to believe. The national average savings account rate in 2026 is about 0.41%. That is what the big traditional brick-and-mortar banks pay. Meanwhile, the top online high-yield savings accounts are paying somewhere in the range of 4 to 4.5%, with some promotional rates going higher. Both of these are federally insured. Both let you withdraw your money. Both are just savings accounts. The only real difference is that one pays you roughly 10 times more than the other. So why does this gap exist? Is it a trick? No, it is overhead. Traditional banks run thousands of physical branches, each with rent, staff, and utilities. All of that costs money, and that cost comes out of what they can afford to pay you. Online banks do not have branches. Lower overhead means they can pass more of the interest back to you in the form of a higher rate. That is the entire secret. In fact, online banks make up 8 of the top 10 highest yielding accounts for exactly this reason. Now, why am I teaching you a framework instead of just naming the highest account today? Because savings rates are variable. The bank can change your APY at any time, and they usually do within a few weeks of the Federal Reserve moving its benchmark rate. Whatever number is best this week might not be best in 6 months. But the method for evaluating accounts does not change. Learn the method once, and you are set no matter what rates do, and that starts with understanding the anchor. High-yield savings rates track the Federal Reserve's benchmark rate. In 2026, the Fed's rate is sitting in the range of about 4.25 to 4.5%, which is exactly why the best savings accounts can advertise rates near 4.5%. This is the single most useful thing to understand, because it gives you a reference point. You should always judge a savings rate relative to the Fed rate, not in a vacuum. If the Fed rate is around 4.5% and a savings account is offering 4.4%, that is excellent. If it is offering 0.4%, they are pocketing almost the entire difference. Once you know roughly where the Fed rate is, you instantly know whether an account is treating you well or robbing you politely. Okay, the 5 variables, this is the whole framework. Variable 1, the APY, judged relative to the Fed rate, like we just said. A PY stands for annual percentage yield. It is the effective yearly rate after compounding. Higher is better, obviously, but the key insight is the reference point. In a 4.5% Fed environment, anything below about 3.5% is underperforming, and you should keep looking. You are not trying to find the single highest number on earth. You're trying to find an account that sits close to the Fed rate from an institution that will keep it competitive. Variable 2, insurance. This one is non-negotiable, and it comes before everything else. Before you look at the rate before anything, confirm the institution is federally insured. For banks, that is FDIC insurance. For credit unions, it is NCUA insurance. Both protect your deposits up to $250,000 per depositor, per institution, per ownership category. If the bank or credit union fails, the federal government reimburses you up to that limit. You do nothing, it just happens. Here's the part to watch. A lot of the slick fintech apps offering savings accounts are not banks themselves. They partner with actual banks and sweep your money to them. And that is how your money gets FDIC coverage. That is usually fine, but you need to verify it. Read the fine print, confirm which bank actually holds your money, and if you want to be certain, you can check any bank status directly at fdic.gov. Never, and I mean never, put money into a high-yield account at an uninsured institution, no matter how juicy the rate is. A high rate on uninsured money is not a deal. It is a gamble. Variable 3, fees. This is the silent killer, and it quietly erases your interest while you are busy feeling smart about the rate. Here is a scenario that catches people. An account advertising 4.00% APY with a $15 monthly maintenance fee can actually be worse than a fee-free account at 3.80%, depending on your balance. Because that $15 a month is $180 a year coming straight out of your pocket, regardless of what you earn in interest. So look for no monthly maintenance fees, which the best accounts do not charge. And then check the rest of the fee schedule. Wire transfer fees, excess withdrawal fees, paper statement fees. A great rate with a stack of fees underneath it is not a great account. Variable 4, minimums and qualifying activity. This is where headline rates hide their conditions. Always check 3 things: the minimum to open the account, the minimum balance to actually earn the advertised rate, and the minimum balance to avoid fees. Sometimes that shiny 4.5% only applies above a certain balance tier, or only if you set up a direct deposit, or only if you meet some monthly activity requirement. If you cannot comfortably meet the conditions, the advertised rate is not really your rate. Your rate is whatever you get after the conditions you actually satisfy. Variable 5, access and transfer speed. A savings account is not a checking account, so you need to understand how money actually moves in and out. Standard transfers between banks use the ACH system and take 1 to 3 business days. Some banks offer expedited or even instant transfers. Check how many external accounts you are allowed to link, because some banks limit this. Check the quality of the mobile app, whether you can deposit checks by photo, and how reliable it is. This matters most for one specific reason: your emergency fund. If this account is holding your emergency money and it takes 3 days to get it out, that is worth knowing before the emergency, not during it. Now, the traps, because once you know the 5 variables, the last thing you need is to know how banks try to game them. The biggest one is the teaser rate. A bank advertises a flashy 5.00% APY. You open the account, and 3 or 6 months later it quietly drops to 2.00%. The intro rate was bait. This is why you do not just chase the single highest number on a comparison page. You look for institutions with a track record of staying competitive over time, not a fireworks show that fizzles after the promo period. A slightly lower rate that stays consistently good beats a headline rate that collapses. The second trap is rate chasing churn. Once people discover high-yield savings, some start hopping to a new account every time someone offers 0.1% more. Moving your money, relinking accounts, updating transfers. For 0.1%, it is usually not worth the friction. Pick a consistently strong account and let it work. Chasing tiny differences forever is its own kind of trap. And the third, which we covered, but it is worth repeating because it is the only one that can actually hurt you: never chase a rate into an uninsured institution. Every legitimate account we are talking about carries the same federal guarantee. The moment you leave that guarantee for a bigger number, you have changed the entire risk equation. Now here's the thing I promised you at the start: the situation where a high-yield savings account is actually the wrong choice. Savings account interest is fully taxable. Every dollar of interest you earn is taxed as ordinary income, both federal and state. The bank sends you a 1099 form for it, and it gets added to your taxable income for the year. Here is where that matters. If you live in a high-tax state like California or New York, and you are in a high-tax bracket, there is an alternative worth knowing about: interest from U.S. Treasury bills, and I-bonds is exempt from state and local income tax. For a high earner in a high-tax state, that state tax exemption can effectively be worth an extra 40 to 60 basis points, compared to a savings account paying the same headline rate. So a Treasury bill yielding the same as your HYSA can actually put more money in your pocket after tax. For most people in lower tax states or lower brackets, a high-yield savings account is still the simplest and best home for cash. But if you are a high earner in a high-tax state sitting on a large cash balance, that is the one situation where the default answer might not be the best answer. Worth a 5-minute look. Which brings me to the most important reframe in this whole video. What is a high-yield savings account actually for? It is not an investment. It is not where you build wealth. The rate, even at 4.5%, roughly keeps pace with inflation. It is not growing your money in real terms in any serious way. What a high-yield savings account is for is money you need to be safe and accessible. Your emergency fund, short-term goals like a car or a down payment in the next year or two, cash you genuinely cannot afford to put at risk. The goal here is not to squeeze out the absolute maximum yield on planet Earth. The goal is to stop leaving free money on the table with a lazy 0.4% account while keeping your cash completely safe and completely liquid. That is the whole job. Quick note, this is a framework for how to evaluate accounts, not a recommendation of any specific one. And rates move all the time, so always verify the current numbers yourself before you open anything. So here is your 10-minute action plan. Check what your current savings account actually pays you right now. If it starts with a 0, you already have your answer. Then look up roughly where the Fed funds rate is so you have your reference point. Find an FDIC or NCUA insured account, verify the insurance first before the rate. Confirm it has no monthly fees and no minimums you cannot meet. Check that the rate sits close to the Fed rate and comes from an institution with a consistent track record, not a 3-month teaser. And make sure the transfer speed works for how you will actually use the money. That is it. 10 minutes once, and your emergency fund goes from earning you almost nothing to earning you real money without taking on a single bit of extra risk. The best high-yield savings account is not a specific bank name that will be outdated by the time you watch this. It is whichever account today checks these boxes. Now you know how to find it, this year, next year, and every year after. If this made the whole thing click, send it to someone you know who is still parking their emergency fund at a big bank earning 0.4%. They are quietly losing hundreds of dollars a year, and they have no idea.